don't lose money. Just don't. Easier said than done, right? Don't lose money. So welcome back to my channel, and in this video I want to talk about how to invest $100,000 in stocks and focusing on not losing money. So if you have been learning investing for a while, you probably have heard of this quote from Warren Buffett: don't lose money. And it's probably his #1 rule, and if you are his true fan, then do you know what his second rule is? Is to don't forget rule #1. When you're investing with 100K, that's quite a big balance. You're somewhere between, buying more real estate properties versus putting it into stocks. Now, the first thing you need to consider when investing in stocks is not the upside. It's going to go big. It's going to make you a millionaire. That is not the first thing you should consider. Instead, you should think about whether you will lose money or not. And that's probably what most people skip over, and that's when people get caught off guard and they lose money. So in this video, we're going to talk about 5 ways that you can lose money, and you should avoid them when investing in stocks. Now, of course, if you are choosing a mutual fund in the market, then your responsibility is really just choosing the fund, and the fund manager will help you invest in whatever stocks he thinks is the best. So you don't really have the responsibility for management. So this video is really applicable to people who are investing in the market. You want more control over your portfolio and you're not sure what to do, and now you're picking stocks. Now, the first thing you want to avoid, or the first thing you can lose money, is to invest in high-risk stocks. Now, what do I mean by high-risk stocks? These stocks might not be making money. They are probably a new industry with heavy regulation. So when you're investing in a stock that is not making money, and let's say I'm a pension fund with 100 investments, the first one I'm going to dump is the one that is not making money. Because as an investor, I want to invest in something that is making money, is growing, and is bringing me income. So those high risk, not making money stocks will be first to be dumped, and that's why the price goes down first. The second type of stock is really low cash balance. What do I mean by that? Now, if you think about a stock like a person, a person needs money to buy food, a person needs to pay rent, a person needs to employ other people for services like shipping from Amazon, so on and so forth. So a person needs money to survive. And of course, the more money a person has, the more comfortable and safe he is. Same thing applies to companies. Now, if the company you're investing in has a very low cash balance, is on a lot of loans, and it's barely getting by, then the risk of bankruptcy is quite high. So that is another stock you want to avoid, is low cash balance. Third, high leverage. Now, this can be a double-edged sword. Now, if you look at some of the videos I have made before, I actually suggest you to use leverage. And I'll talk more about this in another video, but sometimes high leverage can lead to high interest expense. And that means, imagine you have a credit card loan and you're paying a lot of interest on the loan, and if you couple that with a low cash balance, then suddenly there's a high risk that the company can't pay off its loan and then later on declare bankruptcy. So right now we're in the middle of the coronavirus crash, and you're going to find a lot of companies who have a high debt balance struggle a lot, and the equity, which is the stock price, goes down by quite a bit as well. Now, the fourth one is really qualitative. When you're investing in a company, you want to make sure you know the company very well, and you want to understand whether the people in the market are using their products. Now, for example, let's say if you're investing in Starbucks, then you better be drinking their coffee. So then you know whether their coffee is good or not. if you are investing in Walmart, then you better be going to Walmart. So then you can see whether people are going to Walmart or not. And that level of understanding, just by being the customer of the companies you invest in, will give you a slight advantage over even professional investors. And here's an example. Right now, a lot of funds in US and Canada are looking to invest in China. A lot of Chinese stocks are going to go IPO in US. Now, of course, there is a lot of growth opportunities in China, but then there's also a giant disconnection between US and China, and how it's hard to get an understanding of what's going on in China when you're in US or in Canada. So whether a company is performing good or bad, you're really relying on news, which might not be a reliable source. So when you're investing in a company, you want to make sure you understand the company's products very well. Ideally, you should be a customer of that company, so then you know at least whether they're dominating the industry or not. And finally, you don't want to invest in a company that the industry is bad. So for example, let's say right now is 2020, and you want to invest in a newspaper company, and they're printing newspapers still. Now you got to ask yourself, well, what stage is this company at? Is it just growing? Is it just starting out? Is it mature? Is it declining? And that is really the cycle of an industry. It starts as a new industry, for example, like e-commerce. It becomes mature, and then eventually it dies out, and then there's a new industry that replaces it. So when you think about that, well, you want to avoid companies with a bad industry, even though if the company is great. Even though the company is great, you want to avoid it. So those are the 5 tips on how you can avoid losing money when you're investing in the market. And remember, Warren Buffett said, don't lose money. I'll see you in the next video. So thank you for watching, and I hope you enjoyed the video. Please help support me by subscribe, and you can watch the next recommended video here as well. So I'll see you in the next one.